Hello students, my name is Krumal Patel and welcome to Sri Jaindra's Rank Zone classes. I am your friend and mentor for the lecture with respect to paper 1 of CA Foundation course, that is Principle and Practice of Accounting. Today we are discussing one of the important topic for exam point of view, as well as it is a base part of full course of accounting. So kindly pay attention friends. Today we are discussing accounting concept. Accounting concept. What is meant by accounting concept? It's define the assumption. It's define the assumption on the basis of which financial statement of a business entity are prepared. These have universal application as well. First of all, accounting concepts are defined the assumption. Various assumptions have been defined through accounting concept on the basis of which financial statement like profit and loss account, balance sheet, cash flow statement, etc. of the business entity are being prepared. This accounting concept lay down the foundation on the basis of which accounting principles are formulated. So accounting concept first of all define the assumption on which financial statements are prepared, and secondly accounting concepts lay down the foundation on the basis of which accounting principles are formulated. Now friends, we are taking one by one each and every accounting concept. So kindly attention. First concept is entity concept. Here it states that enterprise and owner are separate person. Enterprise and owner are the separate person. Business transaction affecting business. Transaction affecting the business only are recorded in the books of account. Entity concept state that business enterprise and the owner of business are the distinct person or the separate person. Transaction of the business which are affecting the business operation is only are recorded in the books of account. Therefore all the transaction are classified into business transaction and personal transaction. So all the transaction of the classified into two parts. First part is business transaction, second part is personal transaction. Business transaction are only recorded in the books of account. Business transaction are recorded in the books of account, whereas owner's personal transaction recorded in his personal books of account and not in the books of business. Here we are taking one example for better understanding. Mr. A is the owner of CA firm Measures A and Company. Profit arising from Measures A and Company belong to Mr. A only because he is a sole proprietor of the firm. However, for accounting purpose, Mr. A is a distinct or different person and Measures A and Company is a different person. So, according to the entity concept, Mr. A and the Measures A and Company are two different persons. So, accounting will be done only for the transaction in which Measures A and Company is involved and not for A's personal transaction. So, here all the transactions have been classified into two parts: business transaction of Measures A and Company and personal transaction of Mr. A. And business transaction classified under business transaction are only recorded in the books of account, and transaction of Mr. A, which are personal in nature, are not recorded in the books of Measures A and Company. So friends, under entity concept, we seen entity and the owner, and that means business enterprise and the owners are separate person. All the transactions affecting business are only recorded in the books of account. Therefore, we need to classify all the transactions into two parts: business transaction and personal transaction. Business transactions are recorded in the books of account of the business, whereas owner's personal transaction recorded in his personal books of account and not in the books of business. Next concept is money measurement concept. Here, accounting data must be quantified so that data can be aggregated and hence summarized. First of all, data can be aggregated and then summarized. So, data must be quantified. Hence, transaction and event should be measured in terms of money. Transaction and event should be measured in the terms of money. Transaction recorded in the books of account. Transaction recorded in the books of account in the ruling currency. In the ruling currency of the countries where books of account are prepared. So, first of all, accounting data must be quantified so that data can be aggregated and summarized. Transaction and event should be measured in terms of money. So transactions are recorded in the books of account in the ruling currency of the country in which books of account are prepared. As per money measurement concept, as per this concept, only those transactions which are capable of being measured in terms of money are recorded in the books of account. So as per this concept, only those transactions which are capable of being measured in terms of money are recorded in the books of account, that too in the ruling currency of the countries. Here, as for example, rupees in India, dollars in USA, and pound in UK. So transaction for the books enterprise where books of account prepared in India have been recorded in ruling currency, that is Indian rupees. Transactions which are not in monetary terms, even if they are affect the result of business materially are not recorded in the books of account. Sometimes some non-monetary transactions which are capable of being materially affect the business operation are not recorded in the books of account due to it cannot measure in terms of money. So according to money measurement concept, only transactions which are capable of being measured in terms of money are recorded in the books of account in the ruling currency, that is currency of the country where the books of account are prepared. Next concept is periodicity concept. According to this concept, accounts should be prepared after every period and not at the end of the life of the entity. According to this concept, accounts should be prepared for all the period of entity, that is prepared at the periodic interval. Accounting has been done at the periodic interval, not at the end of the life of the entity. This concept make the accounting system workable and term accrual meaningful. It fixes up the time frame for which performance is to be measured. According to this concept, accounts should be prepared after every period and not at the end of the life of the entity. This concept facilitate in comparison. Comparison of what? Comparison of financial statement of different period. Comparison of financial statement of different period. Second, it facilitates in uniform and consistent accounting treatment. For ascertaining the profit and asset of the business. It also facilitates in matching periodic revenue with expense for getting correct result of the business operation. So according to periodic concept, accounts should be prepared after every period and not at the end of the life of the entity. Periodicity concept facilitating comparison of financial statement for different period. It also facilitating uniform and consistent accounting treatment for ascertaining the profit and asset of the business. It also facilitating matching of what, friends? Matching of periodical revenue with the expense for getting out the correct result of the business operation. Next concept is accrual concept. Accrual means, sorry friends, wait a minute. Accrual means recognition of revenue as they are earned. So friends, revenue as they are earned and the cost as they are incurred. So revenue when they are earned and cost when they are incurred. And not when actually money is received or paid. So as per accrual system of accounting or accrual concept, revenue has been recognized as and when they are earned and not required to be recorded on when the money is received. In similar way, cost has been recorded when, or the cost has been recognized when they are incurred and not required to record at the time of payment. All the transaction and events are recognized. All the transaction and events are recognized on mercantile basis. That is, as they are earned or incurred and recorded in the financial statement of the period to which they relate, and not when cash is actually paid or received. Here, as per accrual concept, all the revenues are recognized in the financial statement as and when they are earned or accrued, and not wait for the actual money inflow or actual money is received for said revenue. In similar line, cost cost has been recognized or recorded in the financial statement as and when they are incurred, and not wait for actual payment of the cost incurred. Next concept is, friend, matching concept. Matching concept. Here, performance of business entity is measured with reference to specific accounting period. Hence, to determine the profit for a particular period, revenue earned in the said that period should be matched with the expense incurred for the earning such revenue. So here, performance of business entity is measured with reference to specific accounting period. Here, profit for this particular period determined by considering the revenue earned during that period with the expense, or with the match with the expense incurred for that period. As per this concept, all the expense and revenue of the same period are matched with each other to find out the financial result. This concept is based on the accrual concept, as it considers the occurrence of the expense and income and do not depend on the actual inflow or outflow of the cash. Next concept is going concern concept. This concept is also considered as the basic fundamental assumption of accounting. First of all, financial statement normally prepared on the assumption that the enterprise is a going concern and will continue in operation in future also. It assumed that enterprise has neither the intention nor the need to close the business operation. So, as per going concern concept, it is presumed that financial statement of the business is being prepared on the going concern basis, and or otherwise we can say that financial statement have been prepared on the basis of going concern if it is not followed a going concern, or going concern is not, financial statement is not prepared on the basis of going concern, such fact should be disclosed in the books of account or the financial statement. Valuation of asset of the business entity is dependent on the assumption of going concern. If going concern is taken, any increase or decrease in the value of asset in the short run is to be ignored. So friends, As per going concern, it is assumed that financial statements are prepared as enterprise on the assumption that enterprise is a going concern. Enterprise has neither intention nor the need to close down the business. Valuation of asset of the business entity is depend on the going concern assumption. So, if the going concern is taken or followed, any increase or decrease in the value of asset in the short run is ignored. Next concept is cost concept. As per cost concept, value of an asset as shown in the balance sheet must be historical cost. Value of asset as shown in the balance sheet must be its historical cost, that is acquisition cost. Significance or merits of cost concept. Historical cost is easier to ascertain than the current cost or present value of asset. Next, historical cost represent an actual figure or outflow of resources for acquiring the asset and does not reflect the hypothetical or notional figure. So, as per cost concept, asset of the business which are recorded in the balance sheet must be the historical cost or the acquisition cost. Historical cost is easier to ascertain because actual outflow or actual figure of resources utilized for the acquiring this asset already measured in terms of money, and it does not reflect the hypothetical or notional figure. Next concept is realization concept. As per realization concept, asset is recorded as its historical cost, and any change in its value should only be recognized when it realized, that is at the time of actual sales or disposal of the asset. At the time of sales or at the time of disposal of the asset. This concept emphasizes that there is no certainty of the income until sale has been made, and hence any increase in the value of asset should not be taken into account unless it is actually realized. So, as per historical concept, asset is recorded on its acquisition cost or historical cost, and then after any change in the value should not be recognized unless it is realized into accounts, that is at the time of actual sales or disposal of asset. Next concept is dual aspect concept. Here, this concept is the core of double entry system of account. Every transaction or event has two aspects. Either increase in one asset, similarly decrease in another asset, increase in one liability, decrease in other asset or capital. Dual aspect concept gives the basic accounting equation which is as follows. Equity or capital plus liability, equity or capital plus liability is equal to asset. both the side of equation shall always tally. So as per dual aspect concept, which is based on the double entry system of accounting, every transaction event has two aspects: either increase in one asset, it can be decrease in other asset, or increase in one asset also increase in other liabilities, etc. A dual aspect concept gives basic accounting equation: equity or capital plus liability is equal to assets, and both the side of this equation shall always tally. Next concept is conservatism. Conservatism or prudence defines that unrealized profit and gain, unrealized. Here, unrealized profit and gain should not be recognized, in the books of account. However, provision should be made for all actual and possible losses. Here, as per conservatism or prudence concept, unrealized profit and gain should not be recognized in the books of account. However, provision should be made for all the actual and possible losses. Accountant should not anticipate income but should provide all the possible losses. If there is a choice between two methods of valuing asset, the accountant should choose a method which leads to a lesser value of asset. That is, current asset, or as for example, current asset are valued at cost or NRV, whichever is lower, due to conservatism approach. Similarly, if the market value of fixed asset is greater than the book value of fixed asset, then the difference between market value and the book value should not or shall not be recorded in the books of account, as it is not realized profit. So any unrealized profit and gains should not be recognized in the books of account. However, provision should be made for all actual as well as possible losses. Next concept is consistency. As per this concept, accounting policy should be followed in a consistent way from one period to another period without any change. Accounting policy should be followed in a consistent way from one accounting period to another accounting period without any change in the accounting policy. However, an enterprise should change its accounting policy in any of the following circumstances. First is requirement of accounting standard. Second is requirement of provision of law. And third is for the better presentation of financial statement. So, in any of the following circumstances, accounting policy can be changed. Which are they, friends? First is requirement of the accounting standard. Second is requirement with the provision of law. And third is such change required for the better presentation of the financial statement. So according to consistency concept, accounting policy should be followed in a consistent way from time to time without any change, except three circumstances. Next concept is materiality concept. This principle is an exception to the full disclosure principle. So, friends, first of all, we discuss the full disclosure principle for better understanding of the materiality concept. So, according to the full disclosure concept, or disclose all the material events in the books of account and do not ignore any such event. So, as per full disclosure concept, it's described that all the material events are being recorded in the books of account and do not ignore any such material event. For example, market value of investment, contingent liability, accident due to fire is shown as footnote to the balance sheet based on this concept. So, any contingent liability or accidental event due to fire are required to be shown at the footnote of the financial statement according to the full disclosure. So, full disclosure concept states that all the material events are required to be recorded in the books of account and do not ignore any such material event. Now, we taken the materiality concept. So, this principle is the exception of full disclosure principle. Full disclosure principle means all the material transaction or event are being recorded in the books of account. According to this concept, all important thing of business should be disclosed in the financial statement. Any insignificant item which will only increase the work of accounting and not important for users need should not be disclosed in the financial statement. For example, stationery purchase by organization, though not used fully in the accounting year, purchase still shown as expense of that year only because of materiality concept. Similarly, depreciation on small item like books, calculator is taken as 100% in the year of purchase, though it is used by the company for more than 1 year. So, materiality concept state that any insignificant item which will only increase the work of the accounting and are not important for users point of view or users need should not be disclosed in the financial statement. So friends, today we have completed all the accounting concept. Now lastly, at the end of this session, we consider all the concept in quick manner. Accounting concern for two friends, there are two fundamentals for accounting concept. First is it defines the assumption on the basis of which financial statements are prepared. Second is it laid down the foundation on the basis of which accounting principles are being formulated. And after we seen the entity concept under which we seen that enterprise and the owners are different person. All the transactions are segregated into two parts, business transaction and personal transaction. Business transaction are recorded in the books of business only. Next concept is money measurement concept. Transaction and event should be measured in terms of money, and transaction recorded in the books of account in the ruling currency, that is currency of country where the books of accounting are being prepared. So as per this concept, only those transactions which are capable of being measured in terms of money are recorded in the books of account in the ruling currency of the countries where books of accounts are prepared. Next concept is Periodicity concept. Accounts should be prepared after every period and not at the end of the life of the entity. Periodicity concept facilitates comparison of financial statement, uniform and consistent accounting treatment for ascertaining profit and asset of the business, and it matching periodic revenue with expense for getting correct result of the business operation. Next concept is accrual concept. Accrual means recognition of revenue as they are earned and recognize cost as they are incurred and not when money is actually received or paid. So all the transaction and event are recognized on mercantile basis as they are earned or incurred and not and recorded in the financial statement on the period to which they relate and not when cash and is actually received or paid. Next concept is matching concept. Performance of business entity is measured with reference to specific accounting period. Hence, to determine the profit of a particular period, revenue earned during that period should be matched with the expense incurred during that period. Next concept is going concern concept. Financial statement is prepared on the assumption that enterprise is going concern. It is assumed that enterprise neither the intention nor the need to close down the business operation. Further valuation of business asset is dependent on the going concern assumption. If the going concern assumption is taken, any increase or decrease in the value of asset in the short run is being ignored. Next concept is cost concept. As per this, value of an asset which are shown in the balance sheet must be its historical cost or the acquisition cost. Benefits of cost concept. Historical cost is easier to ascertain compared to current cost or present value cost concept, etc. Historical costs represent an actual figure or the actual outflow of resources for acquiring the asset and does not reflect hypothetical or notional figure. Next concept is realization concept. An asset is recorded as its historical cost and any change in the value should be recognized when it is realized. That is at the time of actual sales or disposal. Next concept is dual aspect concept. This concept is the core of double entry bookkeeping system. Every transaction or event has two aspects, either increase in one asset or decrease in other asset, increase in one asset or increase in liability, etc. Dual aspect concept gives us a basic accounting equation: equity or capital plus liability is equal to asset. Next concept is conservatism. It states that unrealized profit and gain should not be recognized in the books of account. However, provision should be made for all the actual and possible losses. So, if there is a choice between two methods of valuing asset, the accountant should choose a method which leads to lesser value of asset. As for example, current asset, that is stock in trade, are valued at cost or NRV. NRV means net realizable value, whichever is lower. Similarly, if the market value of the fixed asset is greater than the book value of the fixed asset, then the difference between market value and book value should not be recorded in the books of account as it is not realized profit. Next concept is consistency. As per this concept, accounting policy should be followed in a consistent way from one period to other period. Enterprise should not change accounting policy unless and otherwise such change required by the following circumstances: requirement of the accounting standard, requirement with the provision of law, or for better presentation of financial statement. Next concept is materiality concept. Here, any insignificant item which will only increase the work of accounting and not important for users' need should not be disclosed in the financial statement. Lastly, full disclosure. Here, all the material events shall require to be disclosed in the books of account. So friends, today we completed one of the most important part of the chapter 1. So mark this as a, wait a minute friends, mark this topic as a most important part of the syllabus. Most important part of the syllabus. So thank you friends.